Hello, everybody. Professor Barth is here, Associate Professor of History at Arizona State University. Inflation Nation May update. Of course, the latest numbers is this morning from the Bureau of Labor Statistics, the CPI, the Consumer Price Index. Year over year for the month of April, 8.3%. Outstripping forecast. The estimate was 8.1%. We're at 8.3%. And of course, if you've been following my channel, it's all about money, money, money. All the money that's been created, especially since the COVID pandemic, that will require quantitative tightening. More on that in a moment. But there's a look at the long-term graph of the consumer price index for the last 40 years. And you'll see, I mean, we're in dangerous territory here. And in fact, we are now 7 months in a row in which the year-over-year CPI exceeded 6%. 7 months in a row, it's been higher than 6%. And how many is that? Five months in which it's exceeded 7%. Exceeded 5% for the last year. So we've been over 5% CPI inflation for a year now. This is, all right, there's not much optimistic. There's not much of an optimistic outlook that you can take away from the numbers today. Nevertheless, you have a few journalists out there, newspapers that are trying to put a positive spin on it. Inflation decelerates slightly from 40-year highs. CPI rises 8.3% in April. Yahoo Finance. New York Times also had a slightly optimistic spin headline in response to today's numbers. So what are they talking about? Is there really any reason to be optimistic here about today's numbers? Well, what they're pointing to is CPI month over month. So when we talk 8.3%, in March it was 8.5%, April 8.3%. That's over a year. If you look month over month, I can give you more of a zoomed in look at how prices are changing. And the CPI month over month, in April, prices rose 0.3%. In March, they rose 1.2%. In February, 0.8%. In January, 0.6%. And so the last time it was as low as 0.3% was back in August, September. And so they say there's reason to be optimistic. But let's take a closer look here. Here's month-over-month numbers. The black bars are CPI. The yellow line here is Core CPI. Core CPI. Now, Core CPI excludes food and energy. And the reason why Core CPI is tracked is because food and energy can sometimes be volatile. They're often volatile. And so eliminating those two elements and taking a look at everything else is said to be, and there are challenges to this. I don't entirely buy it myself, because food and energy, I mean, you can't come up with two more important items coming out of your paycheck. Nevertheless, I understand the focus on Core CPI. But look at this moving here. Yes, CPI went down month over month in April to 0.3%. By the way, even if you had 12 months of 0.3% month over month CPI, you're still looking at just unacceptable inflation over the year. Nevertheless, look at the yellow line. Core CPI month over month went up. Now, why did that happen? Well, take a look at energy in April. Gasoline. This is month over month. In the month of March, gasoline went up 18.3% in a single month. 18.3%. That drove a significant part of the inflation from March. Not all of it. I mean, energy makes up 8% of the total CPI, so it's still only a fraction of CPI. Nevertheless, 18.3% rise in the price of gasoline in a single month is quite a lot. Look at April, minus 6%. And energy total minus almost 3%. So if energy declined by almost 3%, gasoline by 6% in the month of April, and we still had 8.3% year over year increase in the CPI, and we still had 0.3% increase month over month in the CPI, that means that there remain significant price increases in other sectors of the economy. Hence, core CPI actually went up. And this is very interesting because in my last inflation update in April, I addressed this topic because when the March numbers came out in April, there were a lot of people who said, "Oh, look, core CPI is down." So core CPI went down to 0.3% in the month of March when those numbers came out in April. And so people were like, "Oh, inflation's peaked. See, look, the core CPI is going down." And if you remember my video, I point out, I don't buy that. I don't buy that. First of all, 0.3% core CPI is still quite high. It's a lot higher than what we saw early last fall. And look what happened. Shot right back up again. Let's wait and see. I don't know that I buy that this is a significant drop in core CPI. Markets thought it was. Look at that. U.S. stocks jump after March core consumer price inflation rises slightly less than expected. Well, sure enough, we got the new numbers out today. Bam, it's right back up. Core CPI is now at 0.6%. The April numbers were month over month. So, now, and you look at the prices. Okay, you look at the prices. Okay, core CPI excludes food. Let's look at food. This is year over year inflation. The last numbers that came out for March, meat, poultry, fish, eggs, up 13.7%. Now the new numbers year over year up 14.3%. Actually, eggs went up 10% in the month of April. Eggs went up 10% in a single month in the month of April. Cereals and bakery products in the last numbers were up 9.4% for the year. Now 11.9%. Fresh whole milk was 14.5%. Now 15.5%. Baby food was 10.8%. Now baby food's 13%. And it's all over the news about how baby formula got a shortage. So this is not these aren't good numbers that we received today. Electricity is about the same. Gasoline went down, but we're still looking at, let's not overstate the fall in the price of gasoline. Year over year, for the month of April, gasoline is still up 44% from April 2021. Used cars and trucks went down a little bit from their numbers in March, but they're still up 23%. So, and then there's the issue of shelter numbers, and I addressed this in a whole separate video. You should watch it if you haven't seen it. The CPI, the latest numbers for shelter accounts for 33%. 1/3 of the CPI is shelter. So when you look at the CPI, a third of that number is shelter. The Bureau of Labor Statistics claims that shelter has increased by only 5% since April 2021. Does anybody buy that? Actually, the numbers bear out that rent's gone up about 15-17%. They're saying 5% increase in shelter, and that accounts for a third of the CPI. I don't frankly trust the CPI. Okay, but we'll deal with it. We're using a CPI to analyze things, but the CPI is a flawed metric, primarily for this reason. And I'll granted, it's not easy to calculate shelter because do you have a mortgage? Are you renting? If you're renting, you are paying more. I have a mortgage, so actually everything's remained the same for me. So I haven't seen inflation in shelter. So it's a tricky issue. Okay, I don't envy the people who have to calculate these things, but it is a flawed metric when that's a third of the CPI and they're saying 5% for a large chunk of the American population. They're paying far more than 5% increase from the previous year, right? And again, this is all about the money creation. Just money's been created like like mad. And so what's the Fed doing? Well, last week, of course, the Fed raised rates by 0.5 percentage point. This is the largest hike in more than 2 decades. 50 basis points. The Fed always does 0.25%. They did it 0.5%. By the way, what does that tell you? That the Fed hasn't raised rates by more than 0.25% in over 2 decades. That tells you that tells me that we've had a very dovish Fed for a long time. But there we are. They ain't gonna cut it. It's not gonna cut it. They're gonna have to raise rates more in June. This is the upper limit. The lower limit's 0.75. The upper limit's a percent. That's not gonna cut it. Okay. And then we got the issue of quantitative tightening. I recorded an entirely separate video on quantitative tightening. Check it out if you haven't. Explain in detail about the previous quantitative tightening that happened in 2017 through 2019, and then what quantitative tightening will look like today. But in short, the Fed has to decrease its balance sheet. The Fed's balance sheet is completely is more than double what it was prior to the pandemic. The Fed's balance sheet, its total assets were just over $4 trillion in early 2020. Now we're looking at $9 trillion balance sheet. That's something's going to happen. And when the Fed increases balance sheet, it's creating money out of thin air, injecting it into the economy by purchasing securities. And usually it's treasuries, bonds, okay? Treasuries issued by the U.S. government, so debt, and mortgage-backed securities. So that's what's increased the money supply so rapidly. And then the federal government spent that money like a drunken sailor, okay? So you got two players here. You have the federal government's the drunk, okay? And the Federal Reserve provided the liquor, okay? Now, I don't like the drunk. Stop drinking is the answer. You should stop drinking. But who provided the liquor? The Federal Reserve provided the liquor. And so ultimately, the blame lies at the Federal Reserve, period. That's how I see it. I'm not saying the federal government's responsible. The federal government's acting shamefully, all right? Just like, stuttering around everywhere and drunk as a skunk off cheap money, but the Fed gave them that liquor. And so now we've got to tighten. And the tightening is not going to be pretty. It's the opposite of quantitative easing. And the Fed, the most recent announcement is this. Every month, beginning in June, for the first 3 months, the Fed will allow up to $47.5 billion of treasury bonds and mortgage-backed securities to roll off its balance sheet every month. I believe my memory serves me correctly, $30 billion in treasuries and $17.5 billion in mortgage-backed securities. Allow them to roll off every month, and then the others that mature, you reinvest in them so they don't roll off. They remain on a balance sheet. Then beginning in September, they're going to up it to $95 billion. $60 billion of treasuries and $35 billion of mortgage-backed securities. And so every month, the Fed's balance sheet will decline by $95 billion beginning in September. Not going to cut it, just like the rate hike. All right, look, the Fed needs to raise rates. But the Fed's got to raise rates a lot more than what it's doing. The Fed's going to have to tighten. But $95 billion a month ain't going to do it. You're talking about a year later, what? The Fed's balance sheet's down to $8 trillion? $7.5 to $8 trillion? Not going to cut it. This is what killed the dollar. You want to know what killed the dollar? This is what did it. The U.S.'s greatest hope right now is that all other currencies around the world are trash too. All right? But, wouldn't it be nice to just have a sound currency and not have to bank on other countries around the world also devaluing their currencies? But quantitative tightening is going to have a big impact on the bond market. I've talked about this in my Q2 video. Look, the Fed holds a quarter of all U.S. treasuries, if the Fed doesn't reinvest in U.S. Treasuries and allows those Treasuries to roll off its balance sheet and isn't in there to buy via quantitative easing, what's that going to do to bond prices? Bond prices are going to fall. There's an inverse relationship between bond prices and Treasury yields. The 10-year Treasury yield is going to go up, 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 up. We're already at 3%. When I made that QT video, we weren't even at 2%. Since January, the yield on a 10-year has gone up by 75%, and it's going to continue to go up as quantitative tightening continues. So Jerome Powell has a major problem on his hands. Larry Summers, I've showed this quote before. He's right. Look, there's been few, if any, instances in which inflation has been successfully stabilized without recession. Inflation, the Fed can bring inflation under control, but it's going to have economic consequences too. And already the Dow is cratering. Okay, things are uneasy. We are headed into a recession. Either that or just inflation will continue or get worse. Or you could have both. You could have a recession and high inflation, what they call stagflation. Of course, that reminds everyone of Jimmy Carter, and we know what happened there. Joe Biden is, just completely out of touch. Doesn't even really begin to describe it. He's not there. He's not there. He gave a speech yesterday on inflation. He said, I agree with what Chairman Powell said last week, that the number one threat is a strength, and that strength that we've built is inflation. Like, what? Like, it's just so, this guy, like, continually says things that just don't even, like, remotely make sense. Like, just so many example after example. What he said. So Powell made a statement last week that the U.S. economy is strong. It remains strong in his opinion. That the U.S. economy will remain strong, but the number one threat is inflation. And so Biden just like bungled it all in his head. And even though he had a teleprompter, I don't know how that happens. He has a teleprompter. How does he still manage to do this? The number one threat is a strength, and that strength that we built is inflation. Oh my man. I can't. And then the White House economic advisor, Cecilia Rose, said that the inflation is, quote, a consequence of having an effective strategy against the pandemic. Sure, I think American voters are really going to think. I think of voters when they go to the voting booth in November are going to look at those high prices and are going to say, you know what? This is evidence. The economy is doing great, and man, Biden just like really took us through that pandemic. Wow, this is just fantastic. Not gonna work. It's false just anyway. But even if it was true, that's not gonna work politically. Like you better have a better answer than that. But it's not even factually true to begin with. So anyway, that's all. We'll see what the next numbers are. It would be great if the CPI numbers never really get much higher than they are today. I'm doubtful about that. Okay, but things are very, very unpredictable in the economy. So perhaps the CPI will never exceed 9%. I don't know. Okay, it's hard to say, but the Fed is not going to be able to meaningfully bring down inflation to its 2% target, which is problematic as well. 2% inflation is not, there are all sorts of problems with making that the target, but even so, like just accepting that that target, you're not going to bring it down to 2% anytime, even remotely soon, without major, much more significant action than what the Fed's already doing, and that's going to have major economic consequences. So it remains to be seen. So anyway, thank you for watching. See y'all next time. God bless.